So many of you, I'm sure, have had questions about what kind of loans have I taken out, what do I end up paying back, how long is it going to take me to pay it back, am I ever going to get out of loan debt? Sound familiar? So we're going to talk a little bit about that, but I want to take you through the process of how you are getting the type of loans that you receive. So sometimes people say, well, why didn't I get this type of loan versus this type of loan? And who determines what kind of loan you get? And then what are your repayment options once you're done with your programs? So the first thing we really want to talk about is what is financial aid. So a lot of times people come to me and say, financial aid is not loans. Well, financial aid is any type of assistance that you're receiving that helps you take care of your educational expenses. And while those educational expenses may not be covered completely by financial aid, student loans is a part of that financial aid process. So what kind of loans are out there? So there are subsidized loans, and if you were an undergrad, you all are all graduate students, is that correct? Yes, everybody's nodding, good. So some years and years and many moons ago, back in the 1700s when I first started working on my master's, you could still get subsidized loans as a graduate student. That has changed. And so right now, only undergraduate students receive subsidized loans. There's some conversation in the House and all in DC about whether or not they're going to go back to giving graduate students subsidized loans. And subsidized loans means that there's no interest accruing on that loan as long as you are enrolled at least half time, okay? And the current interest rate is 4.29% for the federal direct loans. The next set of loans are your unsubsidized loans. So those loans are accruing interest as soon as that loan disperses to your student account. So when you do your FAFSA, the information comes to VCU, we send you an email and you check into e-services and you see what your loan is. And as graduate students, typically your loans are $20,500 unless you are in a different type of program. So some of the pharmacy loans are different. If you're in school of medicine, it's different. Nursing has some other kind of loans. But your federal unsubsidized direct loans are $20,500. Those loans are capped off by the federal government. So VCU doesn't determine this is how much you get in a sub or unsub. The federal government dictates this is how much students can borrow. Then you have what's called the PLUS loan. That's the parent loan for undergraduate students. And then in recent years, there's something called the graduate PLUS loan. So graduate students, based on their credit, if the $20,500 or $33,000, depending on the type of program you're in, is not enough to cover your expenses and you wanted to get an additional loan, you could apply for something called a graduate PLUS. And that is also backed by the federal government. So those are not alternative loans where you're going through a bank. Those are going through the federal government as well. And then they assign you a lender. Any questions so far about any of the loans that I've mentioned? Okay. And then there's the Perkins loan. The Perkins loan is available for undergraduate and graduate students. It's very similar to a subsidized loan in that the interest is not accruing on the loan as long as you're enrolled at least half time, but it's at a fixed 5% rate. So your unsubsidized loan can change interest rate every year. The Perkins sticks at 5%. If you watch the news, every year you hear the Perkins loan is going away. The Perkins loan is going away. So we heard the Perkins loan was going away and we had to send all this money back because the Perkins loan was going away. And then in February, they came back and said, just kidding. You get to keep it for another year. So for graduate students, we're able to keep it for another year and award students all the way up until September 30th of 2016. For undergraduate students, they're letting us go all the way through the entire 16-17 academic year. So again, they're telling us it's going to go away. Those of us who've been in financial aid and who watch the news, we're like, okay, you say that every other year, and it sticks around for us. So that program is still available at this point.
Is that also in addition to whatever is subsidized?
Yes, that is in addition to any unsubsidized direct loans that you
If you max it already.
Right, so if you have maxed out your unsubsidized direct and you have financial need, then Perkins would be your next option. So who determines what kind of loan you get? And I got this formula so that you all understand how we determine financial need. So of course, if we all went around the room and say, do we all have financial need? We all would say yes, right? Without a question. But there's a formula that we have to use to determine what is your financial need. And that formula is cost of attendance. So anybody have any idea what we mean when we say cost of attendance?
Tuition plus like living expenses and everything else?
Tuition, your living expenses, what else? Your 5 components.
Health insurance?
Books and supplies, because you're on the medical campus, health insurance. Personal miscellaneous expenses. So all that other stuff that you incur while you're here working on your program. So tuition and fees, room and board or living expenses, books and supplies, personal miscellaneous expenses, and transportation expenses is what we use to come up with a cost of attendance. So tuition and fees, as you all know, is set by our Board of Visitors every May 1, or that first week of May. They come out and say, this is what tuition is going to be for the upcoming academic year. So that's how we know what tuition and fees will be. We use an average for room and board, so we look at housing around the Richmond area, including housing on campus, to come up with an average. The housing allowance for undergrads is definitely different from graduate students. You don't have the same type of housing allowance. As graduate students, it's a little bit more. Your books and supplies will differ based on your program. So again, being in a medical field, we know and understand that there are some supplies that you may have to buy that other students don't have to buy. So we get averages from your departments and areas to understand what is it really costing a student every year to attend VCU in this particular program. Yes.
I know you said that tuition is set by the Board of Visitors on May 1st.
Mhm.
Is that so when you disperse out the loan payments, or not loan payments, when you disperse out the loan amounts or the financial award amount, is that dispersed after May 1st, after they decide on how much it's going to be?
Right, so they decide on or around May 1st. So that first week of May is when the Board of Visitors meets and they determine tuition and fees. Your awards, and most of you, I think, start in the summer. You start like July or somewhere around there. Then your awards are dispersed after that point. Yep. So typically your awards should be dispersed from financial aid to student accounting, barring that there are any holdups. Like one of the things, you have to do electronic consent now every year. So if everything is done, we typically give that money to student accounting, if not the first day of class, the day before class, so that you have any refunds by the first or second day of class. So this is how your need is determined. So we talked about cost of attendance, and your expected family contribution comes from you completing your FAFSA. So when you complete your FAFSA and they say, congratulations, you successfully submitted your FAFSA, it gives you this little number and says, this is your expected family contribution. That's the number that we use to determine your financial need. So that's how we determine if you're going to get a Perkins loan, or if you're undergrad, if you're going to get a subsidized loan. That's how those things are determined. So when do you start repaying your loans? You start repaying your loans 6 months for your unsubsidized and your grad plus. 6 months after you cease to enroll at least half-time or after graduation. If you consolidate your loans, they push that up to about 2 months. So if you've consolidated before, you don't get that same 6-month grace period that you previously received. So if you get a Perkins loan, it's 9 months. You get a 9-month grace period before you have to start repaying your loans. So unsubsidized and grad plus 6 months, Perkins 9 months. And if you consolidate, that's pushed up a little bit. What if you cannot repay? What happens? You gotta come live with me. What happens? So, if you can't repay, there are some options. So the first piece of advice I would give you is that don't ignore your student loans. So you get out of school, you're trying to figure out where you want to be, where you want to live, if you're going to stay in Virginia, you're going to leave Virginia, where you want to work, and that 6-month grace period is up, and you're not exactly in a position to pay, or you just started a job, always contact the lender and have a conversation with the lender. So they do have something called a forbearance. And a forbearance just means that I'm not in a position to pay at this point. So they're not going to do anything drastic to you. But I tell people to talk to the lender and go into forbearance if you can't pay, because that does not have a negative impact on your credit. If you don't pay, that's going to have a negative impact if you don't pay and you ignore them. So you can apply for a forbearance with the lender and say, I just started working, or I'm not working, or I'm not quite making enough to manage my bills and my loan payment right now, so I need some time to get that together. You can do a forbearance for 3 months, 6 months, 9 months, or a year. Payment options. You either had a standard repayment or you had an income-sensitive repayment, and that was it. Now there are probably 8 or 9 different repayment options. So never feel like, if I don't do the standard repayment, which is they take your balance, divide it up, you pay it off in 10 years, and that's it. You may not be able to do that. So there are so many more options available. So they have what's called a graduated repayment, which takes you over 25 years. I see your face. Now, with some of these, what's going to happen is that you're still accruing interest, right? So you're still going to be paying interest, though you're paying it over a longer period of time. You have an extended repayment, which is about 15 years. So you can make these kinds of negotiations with the lender. Let's say you go out and you're like, I'm going to take a position that I know is not going to make a lot of money up front, but over time you're going to make more money. You can get something called an income-sensitive repayment option. So as your income goes up, your payment goes up. So it's right in line with what you're making. But don't feel boxed into that standard repayment of 10 years. And that's some of the pay as you earn as well. So pay as you earn does the same kind of thing. You're on this gradual, this is where I'm paying, and this is what I make, so we're kind of even keel. As you make more, you go up the ladder. So there are 8 options. So again, don't feel boxed in, and if you can't make a payment, okay, I can't do anything. You have some options available to you. I have this calculator link that I want to show you just so that you get an idea of what it looks like. So there's the standard repayment option, and it's going to have you pay $100 every single month until the loan is paid off, and it tells you how much the loan amount was total after you paid it off. So you probably paid about $2,000 worth of interest, because I'm assuming this is a $10,000 loan. Then you have a graduated repayment where your first payment might have been $56, but your last payment is going to be $168. And you see the difference in how much you pay based on the interest that you're earning. And loan forgiveness, I am not as familiar with all the loan forgiveness programs for the medical field. I know teaching has some loan forgiveness programs. If you teach a certain area in a certain subject matter, then you can get some loan forgiveness. Typically, those loan forgiveness programs, you have to go into an income-sensitive repayment. And so people say, well, Theresa, you got to do 10 years. Do standard. Well, if you do the standard, that's 10 years you've paid the loan off. That doesn't help you if you're going to do loan forgiveness. If you do income-sensitive, then it makes your payment lower. You pay over 10 years, there's still a balance that they will forgive. Okay? But if you use this calculator and plug in your loan amounts, it will show you for each one of those repayment options what it's going to look like for you. What your initial payment will look like, what your graduated repayment will look like, and then if you're eligible for loan repayment or loan forgiveness, if you're eligible for loan forgiveness, it will let you know that as well and how much of that loan will be forgiven. Any questions for me?
I feel like from several sources heard this rumor that and I've never looked it up myself, that if you don't pay up your loan within 30 years, or you die, like it will not like transfer to your children or anything. Is that true? Or have you ever heard that kind of thing?
That is true. So as long as your loan is not co-signed by anyone, so if you do a graduate plus loan and they require you to get a co-signer, if something were to happen to you, then it's going to go to whoever that co-signer is. But your regular student loan debt will follow you to the grave. And then nobody else is responsible for it. But anything that somebody has co-signed on, they're going to be responsible whether you were here or not. So no, your children won't have that burden.
Yeah. Well, I want to have it my whole life either, right?
You won't have it either. You won't have it either. You'll be fine. What other questions do you all have? Yes.
So if you decide to do like another educational degree, would the payments be like later on too? Or the 6 months is still standard, if that makes sense?
Good question.
Yeah.
So if you finish this program and you decide I'm going to do another program, as long as you are enrolled at least half-time, it will put your loans in a deferment status. So then you won't have to make payments until you are done with that program or less than half-time. And also know that there are loan limits. So as you are going through your educational career, if you borrowed as an undergrad, that total kind of follows you even as a graduate student. So as a grad student, your loan max is $138,500 over the lifetime of your educational career. So if you borrowed as a graduate student, you went and got a master's degree, like I'm working on my PhD, every loan that I borrow, I can't exceed that $138,500. If you are in medical school, it's $224,000.
Is there a limitation as to how many loans or a loan amount that you can give to each student? And assigning that, so like, let's say you're given, let's say like $100,000 worth of Perkins loans, and you have to disperse out to the whole entire health system college, you kind of just pick out who you feel like needs the most, and then like you just assign it from there?
So we get a pot of money in Perkins.
Okay.
And then we decide for undergrad and grad how much of that's going to be split for undergraduate students and how much of that's going to be grad. And the grad piece typically comes here to the medical campus. And then it's based on the financial need, because Perkins you have to have need, and then how much money we have left. And how soon you get your FAFSA done.
And how fast is the FAFSA done?
So, everybody got their FAFSA done already? I'm seeing some, maybe not so much. So the priority deadline for FAFSA was March 1. So if you have not done it, and you're going to be here for the next academic year, I would encourage you to get it done as soon as possible.
So what about like years from now when I'm making money and I want to buy a house?
Uh-huh.
And I have to take out a loan for that. Is there like any kind of like help out? For like, are you just combo them, or I just have like two massive debts that I have hanging over me, or like?
You have two debts. You can't consolidate your student loan into another type of loan. So you just have those two types of debt. The student loan debt does not look as bad as credit card debt. So I will say that to you, because I know a lot of times students are like, I don't want all this debt. Student loan debt looks favorable versus I've got Macy's and all the other credit cards and these revolving credit. And those are sky high. So, yeah, you'll be okay. You'll be okay. It won't be massive debt. You're gonna make lots of money. You're gonna pay it all off, and you'll be like, whatever, no biggie. I have confidence in our students.
So you mentioned you didn't have to pay on your debt unless you fall below half-time. If your program takes you below half-time, like during the summer or something, but it's not greater than the 6 month period, that you don't fall into the category of having to pay.
Correct.
Okay.
So summer, couple months, no big deal. Then in the fall, you're back to being a full-time or half-time enrolled student in college. Any other questions?
This is something I guess I could just check personally, but I haven't, still not paying on my loan right now, really. But You said the rate's variable on the subsidized or unsubsidized?
On the unsubsidized, so every year, you could have one loan that's at 4.29%, another loan that's gonna be at 5% if they make the rate go up. So every year, DC determines this is what the interest rate is gonna be. So you could have multiple unsubsidized loans at different rates.
So
But it
every
won't-
year is considered like a separate loan
Correct,
then, so
yes,
first year was 10%, second year could be 5%.
yeah.
Okay, and for the lifetime of those loans, they're at those different rates?
They are at different rates the entire time unless you consolidate them. So you all will start, as you get ready to approach graduation, then you'll start getting stuff in the mail about consolidation. So you'll start to see things that come through the mail that say consolidated 3%. And for those of you who didn't start in 1700s like I did, that's great. Back in the 1700s, it was like 2.84%, I think was my interest rate at one point. So for somebody like me, it wouldn't make sense for me to consolidate because I would consolidate and my interest rate would go up. To answer your questions, congratulations.
Thank you.
First of all, you would put your wife's income based on when you do your FAFSA. So when are you getting married?
July.
Okay. If you do your FAFSA beforehand, her information does not go on your FAFSA. If you do it July, what day you get married?
10.
You do it July 11th, her information goes on your FAFSA.
But since I did the FAFSA,
Now.
that would have to be for next year then?
Correct, yes. So it's based on where you are currently, what your status is currently.